Hi everyone, welcome to our practice set for the Code of Ethics. Now, before diving into these questions, which by the way, for the Code of Ethics, we have prepared 40 questions, I strongly suggest that you watch first our video on the Code of Ethics snapshot for a review of the salient concepts that we need to remember for the Code of Ethics. So, that particular video is under the playlist Audit Snapshots, and you'll be able to find the Code of Ethics there. But if you have already done that, or if you're already very familiar with the Code of Ethics, let's jump right in. So let's take care of the first 20 questions in this video and then remaining 20 questions for the next video so as not to make it very overwhelming. So let's start with question number one. What is the primary factor that distinguishes a direct from an indirect financial interest? Now, we do get to remember in this case that the presence of financial interests could actually lead to a self-interest threat for the professional accountant. As such, we need to determine if the financial interest is direct or indirect, as this will have a different implication on our evaluation of the threat. For example, when we talk about direct financial interest, regardless of materiality, it will be considered as a threat to independence. However, or the fundamental ethical principles. However, when we talk about indirect financial interest, for it to be considered a threat, it must be material. In other words, direct financial interest, regardless of materiality, and material indirect financial interests will be considered as threats to the fundamental ethical principle. Naturally, we'd like to ask ourselves what's the difference between a direct and an indirect financial interest? The key term to remember is control. So it is considered as a direct financial interest when the company, the firm, the auditor, the professional accountant has control over investment decisions related to those financial interests. So that's why the answer to number one is Charlie. Moving forward to question number two, this one talks about advocacy threat, and let's do a very quick review of the five threats to the fundamental ethical principles as outlined in the Code of Ethics. Of course, we have self-interest threat, we have self-review threat, we have familiarity threat, advocacy threat, and the last one will of course be intimidation threat. So we are looking for the description or the definition of advocacy threat. Let's evaluate our choices. Letter A says when a professional accountant promotes a position or opinion to the point that subsequent objectivity may be compromised. Now, the role of this professional accountant promoting a position or opinion is what gives rise to an advocacy threat. Imagine, for example, when the professional accountant serves as a witness for the client. For example, or is a promoter of the shares of the client. And so, therefore, this professional accountant is seen to be one advocating for the client, promoting for the client. That is why advocacy threat refers to letter A. Letter B, on the other hand, when we talk about as a result of financial or other interests of a professional accountant or an immediate or close family member, since we're talking about interests, this will have something to do with self interest threat, most definitely. Letter C, when because of a close relationship, a professional accountant becomes too sympathetic to the interest of others, is the hallmark of what we call familiarity threat. In Filipino, we call this one some sense of utang na loob, no? When you become also well too familiar or too sympathetic. So that's Charlie familiarity threat. Letter D, when a professional accountant may be deterred from acting objectively by threats either actual or perceived, is the definition of intimidation threat. Of course, the threat that is not defined here is the one relating to self-review threat, and this would of course refer when the product or judgment of a professional accountant gets reevaluated by the same professional accountant. So definitely self-review threat. So number two, the answer is alpha. Moving forward to question number three. Several months after an unqualified audit report was issued, the auditor discovers that the financial statements were materially misstated. The client's CEO agrees that the statements are misstated but refuses to issue a correction and claims that confidentiality prevents the CPA from informing anyone. The question now is the CEO correct? Can the auditor be prevented or prohibited from issuing a new report simply by virtue of confidentiality? The answer here is the CEO is, of course, wrong because this principle of confidentiality does not give you an excuse to no longer correct the misstatements. All right. So we have two options here that points out that the CEO is wrong. We have option B and we have option C. Option B says the CEO is wrong and the auditor has an obligation to issue a revised correct financial audit report, even if the CEO will not revise and correct the financial statements. Well, if you take a look at letter B, precisely, the auditor will issue a revised correct report because the CEO does not intend to revise the misstatements. This could lead to an either qualified opinion or an adverse opinion. In the case of letter C, the CEO is wrong, but since the auditor's report is issued, it is too late to retract, and actually letter C is not correct. The accountant, or in this case the auditor, first requests management and TCWG to prevent further reliance from the report. If they do not take the steps needed to prevent further reliance, then the auditor must seek the advice of legal counsel, because it will now be the auditor who will take those steps to prevent further reliance. So the correct answer to number three is letter B. The CEO is wrong. We do have an obligation to revise our audit report, especially since there are misstatements which management simply refuses to correct. So bravo for number three. Moving forward to question number four, this occurs when any product or judgment of a previous assurance engagement or even a non assurance engagement needs to be re evaluated in reaching conclusions on the assurance engagement, or when a member of the assurance team was previously a director or officer of the assurance client, or was in and was an employee rather, in a position to exert direct and significant influence over the subject matter of the assurance engagement. Simply put, the auditor or the accountant was the one who prepared the information, and now that same auditor or accountant has to reevaluate the information that they previously prepared. This is most definitely what we call a self review threat. It's kind of like writing or answering an essay question in class, and then the teacher telling you to correct your own answer, right? And grade yourself. So that is self review threat. Delta for number four. Number five, the firm or network firm may provide an audit client that is not a listed entity with accounting and bookkeeping services, including payroll services of a routine mechanical nature, provided any self review threat created is reduced to an acceptable level. A special highlight, please, on the fact that this client is not a listed entity. That being said, should the client be a listed entity, the provision of accounting and bookkeeping services, payroll services, are simply not allowed. But assuming that the client is not a listed entity, we are told, yes, you may provide these services provided that the self review threat is reduced. Examples of such services least likely include, let us please highlight that what we are looking for is the least likely. Letter A says posting coded transactions to the audit client's general ledger. Letter B, preparing financial statements based on information in the trial balance. Letter C, determining and posting journal entries without obtaining approval of the audit client. And letter D, recording transactions for which the audit client has determined or approved the appropriate accounting classification. So the key here is that these services must be routine and mechanical in nature. There must be no judgment involved from the side of the auditor. After all, it is the client who owns the business, and so they should still be making all of the decisions. They should still be calling all of the shots. The auditor simply performs the routine mechanical services related to posting coded transactions, preparing financial statements which are lifted from the client's trial balance, and recording the transactions which the clients have decided how to account for. So the least likely to be included is letter C, because should the auditor not obtain the approval of the audit client, that simply means the auditor is making management decisions, which is a big no-no. So the answer to number five is Charlie. Number six, the phase of professional competence that requires a professional accountant to adopt a program designed to ensure quality control in the performance of professional services consistent with technical and professional standards is. We are visiting the fundamental ethical principle of professional competence and due care. Now, we are also reminded that in terms of professional competence, there are essentially two levels: the attaining part and the maintaining part. So when you talk about the attainment of of professional competence, as outlined in letter C, that actually refers to a high quality education plus taking, of course, the examination and a period of work experience that is attaining. Once you have attained the competence, you will then need to maintain it by adopting a program designed to ensure quality control in the performance of professional services. This, of course, involves as well the CPD, or the continuing professional development requirement for our professional accountants. So the correct answer to this one should be maintaining or maintenance of professional competence. Letter B for number 6. Number 7, the assurance team includes number 1, all professionals participating in the assurance engagement, and that is a yes. Number 2, all others within the firm who can directly influence the outcome of the assurance engagement, that is also a yes. And number 3, for purposes of an audit client, all those within a network firm who can directly influence the outcome of the audit engagement, of course, that is also a yes. So the answer to this is bravo, a yes to all three. Number 8, we talk about contingent fees. Now, we know contingent fees are fees that are based on a particular finding. Contingent fees are not allowed for assurance engagements. Let's be very clear about that one. Contingent fees are prohibited for assurance engagements. The question in number 8, however, is about contingent fees used for certain types of non-assurance engagements, because yes, they may be allowed for non-assurance engagements. However, this will still give rise to a self-interest threat. The question is, which of the following principles will be threatened? And the answer here is objectivity, of course. The presence of a fee that is dangled before you based on whatever findings you can achieve will definitely shake the objectivity of the professional accountant. Take note again that this is allowed only for non-assurance engagements. Moving forward to question number 9, which of the following statements is incorrect? Letter A says CPAs lose their independence if they acquire a material indirect financial interest in a client. And letter A is correct. Because this talks about indirect financial interest, materiality plays an important role. Since it is already material, then definitely the CPA's independence is threatened. Letter B, CPAs lose their independence if they acquire any indirect financial interest in a client. This will make letter B as the incorrect statement, as again, for indirect financial interest to be threats, they have to be material. Take a look at letter C. CPAs lose their independence if they acquire any direct financial interest. Letter C is true, because when we talk about direct financial interest, the materiality does not matter. We do not consider materiality. If it's direct, automatically it is a threat. That means all the more that letter D would be a threat, right? It's not only direct, but it's also material. Even if it weren't material, it would have already been a threat anyway because it's a direct financial interest. So the answer to number 9 is bravo. Number 10, we have here May, and May is a non CPA who has a law practice. Mike, CPA, has agreed to pay May 10% of the fee for services rendered by Mike to May's client. Assume no safeguards were applied. Who, if anyone, is in violation of the Code of Ethics? Do take note that in this case, May is a non CPA and is not within the jurisdiction of the Code of Ethics for professional accountants. Absent the safeguards of this particular referral fee paid to May, then it will be Mike who is in violation of the Code of Ethics, simply because May is a non CPA. Number 11, when a professional accountant solicits new work through advertising, the following are allowed. Let's take a very quick pit stop here and let us be reminded that advertising is now allowed in the Philippines. Advertising professional services, advertisements coming from firms or professional accountants are now allowed, but there are certain rules that the professional accountant needs to abide with. So in this case, the following are allowed. Letter A, emphasis on competitive differences, which is a no. So once an advertisement is made for a firm or professional accountant, there could be no scenes where we say firm A versus firm B. Okay, so unlike the traditional advertisements we get to see, so letter A is not allowed. Billboard advertisements are also not allowed. So, not also letter B. Letter C, using the term accredited or any similar words or phrases. Let's just park that to the side for now. Letter D, using actual testimonials by third parties. Unfortunately, testimonials are also not allowed. Therefore, the only item that is allowed here is letter C. However, allow me to make a qualification to this. Using the term accredited or any similar words or phrases is allowed, provided that they truly are accredited. Okay, provided that the accreditation has not expired. So, letter C for number 11. Number 12, contingent fees may be allowed for certain engagements, such as non assurance engagements. In such situations, the presence of contingent fees may, letter A, create self interest threat to objectivity. Actually, it all refers to self interest threat here. So, will it threaten objectivity, confidentiality, professional behavior, or integrity, as what we have previously seen? Contingent fees could actually shake the practitioner's objectivity. So the answer here is letter A. Number 13, when a professional accountant in public practice competes directly with a client or has a joint venture or similar arrangement with a major competitor of a client, a threat to which of the following fundamental principles is created? So, this is quite an interesting scenario we have here. You have an auditor who competes directly with the client or has a joint venture with a major competitor of the client. What do you think is the principle that is being threatened? Is it letter A, professional competence and due care, letter B, objectivity, letter C, integrity, or letter D, confidentiality and professional behavior? Do take note that you are competing directly with a client, okay? Or you are auditing your client and you are auditing a major competitor of your client. So you get to see the books of these two businesses, or you get to see the client's books whom you are directly competing with. What do you think is the fundamental principle that is threatened? And the answer, of course, would be objectivity. I mean, you can imagine, right? You are auditing your direct competitor. So, in that case, most definitely objectivity is being threatened. Let's go to number 14. The Code of Professional Conduct will ordinarily be considered to have been violated when the member represents that specific consulting services will be performed for a stated fee and it is apparent at the time of the representation that so we're looking for the choice here that violates the code of conduct or code of ethics. So initially, you gave a quote of a fee for a consulting engagement, and it was obvious to you at that time that the actual fee would be letter A, substantially lower than the fees charged. So, say for example, you told your prospective client, we're just gonna collect 100,000 from you, okay, but then the actual fee was actually just 70,000. Or letter B, the member would not be independent, which in this case shouldn't be much of an issue as the engagement is actually a consulting service. So it's a non-assurance engagement, independence is not required. Letter C, actual fee would be substantially higher. You told the client we're only gonna collect 100,000, but you already knew at the time that the fee was actually going to balloon, would likely balloon to like say 500,000 because of other incidental costs involved. Or letter D, the fee was a competitive bid. So I think in this case, you would notice that the violation to the code would have been when you quoted a fee when you already knew that the actual fee would be substantially higher. So that should be Charlie for number 14. Number 15, we have two statements and we're going to evaluate whether they're true or false. Statement 1, direct financial interest is a financial interest owned or beneficially owned directly and under the control of an individual or entity, including those managed on a discretionary basis by others. Statement 1 is true. Again, the key term to remember is control. So statement 1 is true. Statement 2, direct financial interest is a financial interest beneficially owned through a collective investment vehicle, estate, trust, or other intermediary over which the individual or entity has control. So again, since the entity has control, this is a direct financial interest, making both statements true. So the answer is bravo. Number 16, which of the following is least likely to create a threat to independence? Take note, we're looking for the least likely. Letter A, the fees generated by the assurance client represent a large proportion of the revenue of an individual partner. So when the individual partner depends, okay, the revenue of that individual partner, there's an undue dependence on one client that definitely creates a threat to independence. Among the many threats that could be created, of course, is a self-interest threat, whereby the individual partner might be scared of losing that particular client. Another threat that may be created would be intimidation threat. Should the client intimidate the individual partner into, I don't know, maybe making sure that the opinion is unqualified, because if they leave, then that partner loses a lot, right? So letter A is definitely a threat. Letter B, accepting gifts or hospitality, the value of which is clearly insignificant from an assurance client. When your client gives you, for example, stationery or ball pens, or maybe some of their, or maybe groceries during the holidays. So that is considered as okay, as the value is clearly insignificant. That will not be considered a threat to independence. Of course, that leaves letter C and D as possible sources of threats. When litigation takes place or appears likely between the firm or a member of the assurance team and the assurance client, or when the firm charges a contingent fee to an assurance client, like what we said, that's supposed to be not allowed at all. So, number 16, not a threat, is letter B. Number 17, which of the following is not allowed to be included in a website of a firm or professional accountants? Letter A, the awards that they have received. Letter B, the names of partners or principals with their educational attainment. Letter C, the listings of the firm's clients. And letter D, membership in any professional body. So definitely, the firm is not allowed to put out a listing of their clients. So that should not be found in the website. So Charlie for number 17. Number 18, a member in public practice may perform for a contingent fee any professional services for a client whom the member or member's firm performs. Letter A, an audit. Letter B, a review. Letter C, an audit of prospective financial information. Or letter D, a compilation used only by management. We remember once again, contingent fees are allowed for non-assurance engagements. And of the four listed here, only the compilation is a non-assurance engagement. That makes the answer to number 18, letter D. Number 19, the existence of an audit committee which acts as an intermediary between the independent auditor and management can be regarded as a safeguard. Letter A, created by profession. Letter B, created with the client. Letter C, created within the business community. Or letter D, created within the firm. So we do remember that when we talk about the threats to independence, of course, there will be safeguards to either reduce the threat to an acceptable level or to hopefully eliminate them. And these safeguards may either be created by the profession or regulation or legislation, or they may be created within the work environment, which could either be created within the work environment of your client or created within the work environment of your own firm. So the presence of an audit committee of the client is, of course, a safeguard created within the client. It's a work environment, but this is from the client side because we are talking about their audit committee. So the answer to number 19 is bravo. Number 20, examples of circumstances that may create familiarity threat. Least likely include, we're looking for the least likely. Letter A says a former partner of the firm being a director, officer of the assurance client, or an employee in a position to exert direct financial influence over the significant matter of the assurance engagement. So many words, but basically what happened here is that this person was formerly an auditor. And when we say auditor, meaning the auditor that is in a position to exert influence over the audit, in this case, a partner. So we have here a former partner who is now employed by the client. Okay, and the firm is still auditing that same client who now has their former partner as occupying a significant position there. Do take note that this former partner, since coming from that firm, would already know about the processes of the firm, their audit methodologies, etc., etc. This one will definitely give rise to a familiarity threat, right? Because that former partner who is now a client is familiar with the audit methodologies used by their auditor. So letter A is a familiarity threat. Letter B, a member of the assurance team having an immediate family member or close family member who, as an employee of the assurance client, is in a position to exert direct and significant influence over the subject matter of the engagement. And again, you would notice this might give rise to familiarity threat, as the member of the assurance team has an immediate family member who has direct influence over the subject matter. So by virtue of this relationship, familiarity threat is also present. Letter C, a member of the assurance team having an immediate family member or close family member who is a director or officer. So, quite similar to letter B, the idea still being that these people, these positions, have a direct influence on the subject matter and the subject matter information. So, still a familiarity threat. However, when we talk about letter D, dealing in or being a promoter of the shares or other securities in an assurance client, this is advocacy threat. So the answer to number 20 is delta. So we are done with the first 20 questions. However, to avoid giving a very lengthy video, we'll cut the discussion very, very quickly here. We'll just take a very short break. And in the next video, we are now going to answer questions 21 to 40. I'm sorry, that's not 50. Should be 21 to 40. So I hope to see you guys in the next video.